Welcome to online classes to become first year students. Subject financial accounting. PPT prepared and presentation doing by Mr.Vinaykumar.C. Last class we are discussing the meaning and definition of accounting, features of accounting, and also we have discussed the other important things towards accounting. Today we are going to discuss the traditional accounting principles. Under the traditional accounting principles, further classified into accounting concept and accounting convention. Basically, accounting concepts are the fundamental idea, are also called as a basic assumption in theory and practice of accounting, whereas accounting conventions are the customs and practices which have been in force for a long period. The basic principles of accounting are essentially the general decision rules which govern the development of accounting techniques. These principles guide how transactions should be recorded and reported. Let us discuss the important basis accounting principles. The first one is accounting entity principle. According to this principle, a business is treated as a separate entity that is distinct from its owners and all other proprietors. That means any person who is investing money in a business, the business is separate from the owners. So that's why under the balance sheet on the left hand side we are showing a capital as a liability. So this is the one of the assumption under accounting principles. Next, accounting period principles. It is also one of the principles known as periodicity principle and also called as time period principle. According to this principle, working life of an enterprise is artificially split into periodic intervals which are known as accounting periods. At the end of each period, an income statement and position statements are prepared to show the performance and financial position. So here, this is also one of the assumption that the enterprises is a working life is a long period. So monthly, quarterly and half of the yearly we are going to prepare the financial statements, okay, for the purpose of knowing the results in the form of profit or loss. Next one, money measurement principle. So any transaction which is taken place in a business, we are going to measure in the form of money, which are capable of being expressed only in terms of money or includes in accounting records. Non-monetary events are not recorded. For example, if the marketing manager is not in good terms with the production manager, the enterprises is bound to suffer. This fact is not recorded in accounting records, as monetary measurement of this information is not possible. So this assumption treats all rupees alike, whether it is rupee from 1980 or 2010. Hence, nowadays it is considered to provide additional data showing the effect of price level changes. The next one is a going concern principle. It is also known as a continuity assumption. According to this principle, the enterprises is normally viewed as a going concern, that is, a concern that will continue to operate for a long period of time. So, here the assets are classified as current assets and fixed assets. The liabilities are classified as short-term liabilities and long-term liability. According to accounting standard number 1, if this principle is followed, this fact need to be disclosed in the financial statement, since it is acceptance and use are assumed. Next one, consistency principles. This principle stresses that the accounting practice and method should be remain unchanged from one accounting year to another. Whatever accounting practices are selected for a given category of transaction, they should be followed consistently. For example, if the inventory is valued on LIFO basis, this basis should be followed year after year. Next, Predense Principle. It is also known as Conservatism Principle. In this case, anticipate no profit but provide for all possible losses should be applied. In the accounting records and the financial statements, all the prospective losses, risks and uncertainties should be provided for, but prospective profit should be ignored. This principle requires that in the situation of uncertainty and doubt. Next, full disclosure principle. According to this principle, the financial statement should act as means of conveying and not concealing. That means the financial statement must disclose all the relevant and reliable information. The company should not hide any information, even though it is in the form of dividend, or it is related to the value of asset, or the company is taking loan from the outside, anything. So the idea behind this principle is that the financial statements are essential meant for external users. On the basis of this information conveyed by the financial statement, that the external users can make decisions. Recording of transaction. So basically the students are familiar with a business transaction, how a company can record that business transaction. So what the meaning of a transaction? A transaction is an event involving some value between two or more business entities. Every transaction involves give and take aspects. For example, a purchase of goods and also the receipts of money, the payment to the creditors and also the payment of expenses, etc. So here a transaction may be a cash transaction or may be a credit transaction. In a double entry accounting, every transaction affects two accounts and is recorded in these accounts. When recording the transaction, the total amount debited must equal to the total amount credited. So this is a policy we are following from the beginning the accounting came. As the accounting is in T format, the left hand side is called a debit side and the right hand side is called a credit side. This format of the account helps in recording the increases and decreases in the item. Next, rules of debit and credit. Basically, the common students, they are familiar with what is debit and what is credit. And also we know all the accounts are divided into 5 categories for the purpose of recording the transaction. They are asset, liability, capital, expenses or losses, and then revenue or gains. So, and then the fundamental rules are followed to record the changes in the accounts. They are: the first one, increase in asset should be debited, decreasing in assets is credited. Another fundamental rule is increase in liability is credited and decrease in liability is debited. The next fundamental rule is increase in capital is credited, a decrease in capital is debited. And fourth fundamental rule is increase in expenses bar losses is debited, decrease in expenses bar losses is credited. And last one, increase in revenue bar gains is credited, decrease in revenue bar gains is debited. So these are the fundamental rules of debit and credit. Once again, we are going to discuss the another accounting principles. The first, the next one is material principle. So material principle, it is also the part of accounting. Here, basically an exception to the full disclosure principle. According to this principle, in accounting, a detailed record is made only of those business transactions which are material, that means significant to the user of accounting information. So the full disclosure principle requires that all the facts necessary to ensure that the financial statements are not misleading must be disclosed, whereas the materiality principle requires that the events not being relevant to the users need not be disclosed. Example, recording of small calculator as an asset in the balance sheet may not be justified due to the cost of recording over the benefit. The next one is historical cost principle. Here, an asset is ordinarily recorded in the accounting records at the price paid to acquire it. The market price is ignored. The cost becomes the basis for the accounts during the subsequent accounting periods. This principle is of relevance only for fixed asset and not for current asset. Next one, revenue recognition principle. Under this principle, mainly concerned with the revenue being recognized in the income statement of enterprises. Revenue is the gross inflow of cash from the sale of goods or from provision of services to customers. It excludes the amount collected on behalf of the third parties, such as certain taxes. Next one, matching principle. Profit is the result of two factors, that is revenues and expenses. According to this principle, the expenses incurred in an accounting period should be matched with the revenues recognized in the period. If the revenue is recognized on all the goods sold during a period, or the cost of those goods should also be charged to the period. Duality Principle. Under the Duality Principle, always the results in receiving some benefit and giving some benefit are of equal value. That means two-fold aspects of transaction is called dual aspect. This duality is the basis of double entry records. For example, Mr. X sold goods for cash 1000 to Mr. Y. So here the dual aspects are Mr. X. Receipts of cash is 1000, foregoing of goods is also 1000. So the journal entry, cash account data to Y account. So in the cash account we are debiting 1000, and in the Y account we are crediting 1000 rupees. Once again, so this is the example for cash received from Y. But if you are selling the goods to Y, the journal entry is Y account data to sales account. Then another example is Mr. X sold goods for 1000 to Mr. Y on cash basis. So it is completely the journal entry cash account data to sale account. If it is credit, the entry is Y account data to sale account. Anyway, the duality principle is related to the dual aspects. Next, objectivity principle. And one more is timeliness principle. Under the objectivity principle, all accounting items should be evidence and supported by source document. Such source document must be completely objective. That means verifiable and free from personal bias. This principle requires that each recorded transaction should have an adequate evidence to support. Under the timeliness principle, timely information should be made available to the decision makers. The quarterly reports are made available immediately on the quarter end. It may lose its relevance if the information contained in the quarterly reports are made available in 6 months. This provides timely information to the investors and the potential investors to make their investment decisions. Thank you for watching.